Welcome back to Investing Talk Podcast.
Today we're looking at LM Funding America.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get right into the analysis of LM Funding America, because the story here is it's really one of strategic transformation.
A transformation, okay.
We're looking at a company that is operating with a clear dual revenue model, but those two halves serve very different purposes.
Okay, so let's establish the baseline. What are the two core businesses right now?
On the one hand, you have the legacy component, specialty finance receivables.
Right, that's the original business.
Exactly.
Yeah.
This is the foundation where the company began. It's important because it provides a reliable, if maybe a little slow, stream of cash flow.
Okay, a stable anchor.
A stable anchor, but more importantly, it carries potential tax loss carry forwards.
That sounds like financial jargon. But those are critical, right? Especially for a company that's shifting gears. Why does that matter to an investor focused on the new model?
Well, it matters for future profitability. If the new business segment, and we'll get to this, the Bitcoin mining and treasury, becomes highly profitable,
Which is the goal.
right, then those carry forwards act like a shield. They can significantly reduce or even delay the tax burden on future gains.
So more of that profit stays on the balance sheet for, I guess, further accumulation.
You got it. The legacy business is essentially a tax-efficient anchor for the whole operation.
That's a compelling way to look at it. So we have this stable piece that offers tax advantages.
Yeah.
But you mentioned a pivot. Where is the strategic focus overwhelmingly centered now?
The focus is now heavily, almost exclusively, on their emerging Bitcoin treasury and mining segment.
Okay.
The management team has made it crystal clear through their capital deployment that this is the engine of growth and really the primary driver of future valuation.
Let's unpack that pivot then. Because, plenty of public companies are just buying and holding Bitcoin on their balance sheet. That's a popular play.
It is.
How is LM Funding America structured differently? What's their supposed operational moat?
This is where it gets really interesting. They aren't just a buyer. They are a vertically integrated Bitcoin accumulator.
Vertically integrated.
They combine owned physical mining capacity with a direct Bitcoin accumulation strategy for their corporate treasury. It's a mechanism, not just a holding pattern.
So instead of being purely passive, they're manufacturing the commodity they're trying to accumulate. But does that mining segment actually pull its own weight right now? Especially with all the overhead of running a public company.
It does, and that's the key. The data shows that the mining operations segment is currently profitable on an operating income basis.
Profitable already.
Yes, and this is the key structural advantage. That cash flow does two things at once. It covers their public company overhead, which is often a huge drain for small miners, and crucially, it funds incremental Bitcoin purchases.
That's a huge distinction. That completely changes the risk profile.
It does.
If they're generating coins and using that cash flow to buy more coins, they aren't wholly dependent on the equity markets every time they want to grow their treasury.
That self-funding mechanism is the moat. Think of a pure play holder, like a trust or a fund.
Right.
If they want to double their Bitcoin holdings, they almost certainly have to issue new equity, which is dilutive. LM Funding America, in theory, can achieve this sort of self-reinforcing accumulation.
A perpetual accumulation cycle.
Exactly. Mining profits lead to more Bitcoin purchases, which increases the treasury value, which further de-risks the balance sheet.
I understand the attraction of that loop, but let's push back a bit. Relying on mining cash flow is inherently volatile.
Of course.
Bitcoin difficulty changes, transaction fees fluctuate wildly. If those revenues dry up temporarily, doesn't that moat instantly disappear? Doesn't that force them back to those very dilutive raises you just mentioned?
That is the core risk investors have to monitor, no question. The profitability of that mining segment is foundational to the entire thesis. If mining margins compress significantly, the system breaks down.
And they just become another high overhead Bitcoin holder.
Precisely. However, what we've seen recently is management pushing really hard on execution velocity to scale capacity quickly, which suggests they're pretty confident in the current margins.
Okay, let's look at that execution then. The thesis might be strong, but rapid scaling requires capital. How aggressively have they actually been deploying their cash?
Extremely rapidly. In August 2025, they completed a pretty significant capital raise. They brought in $23.0 million in gross proceeds.
$23 million, that's not small.
No, and it was split between a $10.4 million PIPE and a $12.6 million registered direct offering. The importance of the PIE is that the price was set at $2.41 per share.
So that gives us a recent institutional valuation reference point for the company's equity.
It does, and the funds were, as you'd assume, immediately directed toward the core thesis.
More Bitcoin and more miners.
Correct. The majority was earmarked directly for Bitcoin purchases and physical mining expansion, and they showed immediate follow-through. Just a month later, in September 2025, they closed the acquisition of an 11-megawatt mining site in Columbus, Mississippi.
For how much?
$4 million, paid directly from the balance sheet.
Okay, so deploying $4 million from the balance sheet into a tangible owned asset like that site validates two things.
Right.
One, their cash position post-raise, and two, their commitment to actually building capacity rather than just, renting it.
And it speaks to that execution velocity I mentioned.
What are the current hard numbers on their accumulation goals? Where are they trying to get to?
They are building toward a significant target of 26 megawatts of owned mining capacity, and currently they've accumulated 150 Bitcoin in their corporate treasury.
And that 150 Bitcoin treasury is the direct leverage component of the stock. For listeners who need some context, what does that translate to in terms of sensitivity to Bitcoin price swings?
It's highly sensitive. Based on our analysis, each $10,000 move in the price of Bitcoin translates to roughly $1.5 million in potential P&L impact.
Just on the existing treasury holdings.
Just on what they hold right now. So if you're bullish on the underlying asset, this corporate structure provides amplified immediate exposure.
That is powerful upside leverage. But let's transition. Every high-growth story has its risks. And in this case, there's a significant structural headwind investors must contend with right now. Equity dilution. What happened there?
This is maybe the most crucial risk point to understand. The biggest headwind is the equity overhang created by a very recent financial maneuver.
And that would be the November 2025 warrant repricing.
That's the one.
Warrant repricing sounds clinical, but the effect can be catastrophic for existing shareholders if it leads to massive new share issuance. Walk us through the mechanics of that.
It was a very aggressive move, and one that signals some short-term stress. They had outstanding warrants, presumably from prior raises, and in November, management reset the terms. This move significantly expanded the aggregate share count to 15.5 million shares. But here's the kicker. They dramatically lowered the exercise price.
From what to what?
From that initial $2.41 institutional reference point, all the way down to just 97 cents per share.
Wait. From $2.41 down to 97 cents.
Yes.
That's not a small adjustment. That's an immediate massive incentive for warrant holders to exercise. They can convert at 97 cents and immediately sell into the market for a profit.
It all but guarantees dilution. It creates this tremendous overhang because the warrant holders now have near zero risk to convert and realize gains, flooding the market with new supply.
It's basically a self-inflicted dilution event that puts immediate and considerable downward pressure on the stock price.
And it's likely a key reason why the stock has been trading at these levels in the first place. They probably needed to clear the balance sheet and just encourage conversion to get it over with.
That paints a picture of really conflicting signals. On one hand, you have this fantastic, vertically integrated operational thesis, the accumulation machine.
Right.
On the other, you have management taking a huge dilution hit. So how are they trying to mitigate that risk and signal confidence to long-term shareholders?
They've taken two key actions to try and counter the narrative. First, they authorized a $1.5 million share repurchase program, also announced in November.
That's a classic move. Management putting their money where their mouth is. Repurchasing shares at these depressed valuations should, theoretically, be accretive to long-term holders.
It signals they believe the stock is undervalued relative to the operational assets. The second, and maybe the most significant speculative catalyst for the future, is tied to their remaining capital raising capacity.
We're talking about dry powder here.
A lot of it.
How much capacity do they have for future moves, given they just raised that $23 million?
They have referenced a $150 million shelf registration that they are, and I'm quoting here, closer to unlocking.
$150 million?
150. It's a massive figure relative to their current market cap and that initial raise.
A $150 million shelf suggests truly aggressive, multi-year ambition. If they deploy even a fraction of that, it completely changes the scale of the operation.
And if we connect this back to the bigger picture, it says the strategy is clearly a multi-year accumulation play. That shelf registration communicates their intention to use favorable market conditions to scale rapidly toward that 26 megawatt target and probably well beyond it.
It shifts the focus from the immediate dilution pain back to the long-term growth potential.
That's the idea.
So if I'm an investor looking at this, what are the immediate validation points? What are the catalysts I should be watching for in the next few months to confirm the machine is working?
The immediate checkpoint is the Q3 2025 earnings release that should be coming out in late November or early December, and we need granular disclosure.
Go specific.
We need to see their exact Bitcoin holdings post-financing, concrete mining production figures showing that profitability is sustained, and clarity on their current cash position after that Mississippi site acquisition.
And beyond the earnings report itself.
Continued success in closing on new capacity, moving them closer and closer to that 26 megawatt target. Every successful acquisition validates their ability to execute on the growth thesis.
So if you had to distill this whole story, the legacy anchor, the profitable mining, the leverage, and the dilution risk, what's the singular takeaway for listeners? Is it the immediate Bitcoin price exposure or the mechanism itself?
It's the mechanism, hands down. LM Funding America is fundamentally different from a pure play holder because of that superior accumulation mechanism. It's not just a Bitcoin buyer, it's a generator, which changes the risk profile by providing that internal funding loop.
So a proxy with operational leverage.
A Bitcoin proxy with operational leverage, yes. But investors have to accept the high risk that comes with volatility and, of course, that massive equity overhang from the recent warrant repricing.
The core question for the investor then becomes, can management utilize that massive $150 million in dry powder fast enough to outrun the dilution pressure they've created? That's something for you to think about as you research this space further.
Absolutely.
If you found this discussion helpful, make sure you hit that subscribe button to catch all our future analysis.